Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. Let's get to your top stories today. The dollar breaks below key levels ahead of the Fed decision, falling to its weakest since the central bank's tightening cycle began more than 3 years ago.
Bloomberg learns that a group including Oracle, Andreessen, and Silver Lake is set to take over TikTok's U.S. operations, leaving China's ByteDance with less than 20%.
Also ahead, China issues wide-ranging measures to stimulate the services economy, building on efforts to boost consumption. Good morning. It's the approach to the Fed decision. Some things haven't changed, some things have changed. So I think just worth noting that we are coming off the longest win streak in terms of Asian equity markets going back to about 5 or so years. So that's 9 straight days. We're snapping that as I speak. That could change, of course, going into the rest of the trading session. What hasn't changed, what has changed is really as it pertains to this weakness in the U.S. dollar and the break below a trend, a break below the July low that we hit, and at 11.88, we're pretty much trading at the weakest or the lowest on this specific measure going back to early of 2022. Gold, as you can see, is inching ever so slowly, but almost surely to the 3,700 as far as spot goes. RSI bottom of your screens. We can talk about that later. In terms of this breakout in the dollar, and as you can see, if you're looking at exchange rates and they don't look familiar to you, it's because they don't. The Aussie dollar, for example, is now 67 cents. Last time we saw roughly these levels was back in 2024. Fix in focus today, dollar again has a 146. Euro dollar is closing in 119. We also get inflation coming through later today out of the UK, plus, of course, the Bank of England decision to contend with, too. In terms of what happened overnight, the Golden Dragon Index, here's an interesting bit. So you have a couple of changes to individual ratings here. The latest one to come through was actually Goldman on Alibaba. The price target lifted there. Arete actually raised to buy. Baidu was raised to buy at Arete. Of course, they changed, I think, their sell rating. So they actually skipped a step into the upside. And, of course, NEO want to focus on as well, given just how the premium there as far as that's concerned. Right. Going into the open today, futures are looking like this. 2 things to note as far as policy pronouncements. We have, of course, at 11 a.m. local time, the policy address coming through out of the chief executive, more with Stephen Engel, of course, our man who's covering this for us. And, of course, later today, I believe it's at 3 p.m. local, is the services sector briefing, maybe to expand on what was already announced overnight in terms of flows. It turned negative for the first time, I believe, in 12 days yesterday as far as that's concerned. But yes, certainly lots on deck. Oh, by the way, I almost missed this. For those who are looking at the weather, a potential T1 typhoon signal could be raised, I think, anytime between tonight and tomorrow morning here in Hong Kong.
Just another day in Hong Kong.
Yes.
Really. Now,
in non-paradise.
But certainly be quite interesting what we're going to hear, whether it's this policy address, but certainly what's really kind of driving these markets is still the tech space. And I think that these upgrades that you're seeing, right, whether it's NEO, whether it's Alibaba, just adds more fuel to this whole AI trade here. The chip stocks in Japan, for example, are on a tear once again.
Yeah.
That Yuan Fix, certainly one to watch now that we have dollar China at a 7.10 handle for your offshore rate. That policy address from John Lee as well. It could be a pretty long speech. Consumption sector, we say, so it's really targeting sports, entertainment. So we'll look for some of those sectors there in particular and whether they move on the back of this 19 sort of measures that were announced.
No new funding, though.
No new funding, though. We'll talk about that. But yeah, gold, property, consumption are certainly the ones to watch there. We talked about the upgrades. CGB sale, too, today.
Yeah, really on the back of that, too. So we're going into this, I think important, the framework here is we're coming off fairly disappointing economic numbers, right? So on top of the services outline that they put out as well, we're getting a few media reports as well. So in terms of the Securities Journal reporting that China has enough fiscal policies to support growth, so that's supporting that narrative. And of course, also coming through on the PBOC front, the Securities Journal, rather, on the PBOC front, is expected to ensure ample liquidity going into September. So they're sort of bringing out most of sort of the backstops here as we go into, I guess, the thick of things, and these markets try and understand where we go from here, especially as valuations have now effectively mean reverted on MSCI China as far as this is concerned.
Yep. And then, of course, we're watching very closely the Fed decision and the like, and I think the vibe getting into this is really to just sell the dollar.
Yeah.
Because of you got to wonder what the dots are going to look like. But when you talk about Treasury yields in the 2-year basically have collapsed some 20 basis points already, how dovish does it have to be to sustain these gains right now?
And what does a Mr. Miran, who's part of the conversation now, effectively mean?
50 basis points, right? Could that still be on the table?
How do they sell that, though? The only time that they've been able to deliver 50, and I think Stephanie Leung out of StashAway, who'll be joining us in the top of the next hour, has pointed out that I think the Fed has only moved 50 in emergency cases, right? In this case, do you backdate? It's backdated 50, right? And what does it mean for the front end of the curve, and how much more collapsing can we actually get as far as Yvonne is pointing on 20 basis points in that. Paul Dobson joins us out of Singapore right now, our executive editor for Asian markets. So, Paul, this time tomorrow, we'll understand where the dots will be. Should we expect trading today to be fairly cautious and range-bound, given how far equity markets, for one, have already melted up, in fact?
Yeah, good morning, David and Yvonne. Well, I think the one thing that you'll want to watch out for is the currency market, as you've been talking about, and whether we get a UN fix below 7.1 today, given the weakness in the dollar overnight. There seems to have been a little bit of resistance to pricing through that level and allowing for further yuan appreciation. So that could be an interesting one to watch out for, not just for the Chinese currency, but as an anchor for the rest of the region. And that may give us a little bit more excitement and volatility. We did see the euro punching through to that 4-year high overnight for us. Otherwise, though, it's that typical kind of pre-Fed lull that we're going to be moving into a little bit. There is some weakness in equities today, and I guess that might have partly to do with the strength of local currencies. But I also wonder if, given that huge rally that we've had, the very long run of gains, there's a little bit of a pullback. People kind of sitting now and taking a little bit of the chips off the table as they get ready to see just how dovish, as you said, just how dovish the Fed is actually going to be.
What are we looking at in terms of how to measure that, right?
Yeah.
I mean, and what could be some of the downside risks to this market if we do hear maybe even not as dovish or even a hawkish sort of Powell later on today?
Yeah, well, Powell's been, relatively hawkish and clinging on to the idea that inflation is not we're not completely in the clear as far as inflation is concerned and the pass-through from the tariffs just yet. We do have, so the expectation is for a cut of 25 basis points today, no more, no less. There may be some dissents in either direction, according to Bloomberg Economics, particularly from Miran, but that seems to be pretty much par for the course. People will look at the dots. Are we going to see one more cut or even 2 more cuts signalled by the Fed policymakers for the rest of this year, and then how much for the rest of next year as well? The market is pricing a total of 6 cuts through the end of next year. So in order for it not to be too disappointed, the Fed is going to have to get kind of close to that in the dot plot indications. We have seen, some ramp up in the options market on people even expecting a 50 basis point cut at some point between now and December. So 100 basis points of cuts through there. They're a bit, it strikes me, as lottery ticket trades or hedges, just in case the Fed goes even harder than we expect. On the other hand, like you said, there's resistance. I think if you listen to what the Fed policymakers have been saying, the likes of Schmidt in particular have been not exactly leaning into the idea that they need to have a whole series of cuts. So it is possible that we'll have quite a split view of opinions, and Powell's going to have to tread very carefully to try to thread that needle in the press conference.
All right, Paul. Thank you. Paul Dobson there joining us out of Singapore on what to expect out of the Fed here today. Meanwhile, we've been talking to our sources and the like about this whole TikTok deal, right? So Bloomberg's been told that the U.S. operations of the company are set to be acquired by a consortium, including the likes of Oracle, Andreessen, Horowitz, and Silver Lake. Let's bring in Annabelle Jewelers. She's been kind of looking at what we've learned so far. What more do we know at this point?
Well, I think a lot of the contours of the deal that are being reported are sort of what was reported earlier this year, and the deal shape we were expecting it to take before it was derailed by tariff announcements. But as you said, there's going to be that consortium. You've got 3 different possible people or groups taking stakes here: Oracle, Andreessen, Horowitz, and also Silver Lake. The important thing, though, is how much of a stake is ByteDance going to have in the business, and that's what's really key in terms of our reporting and what we're hearing from sources, and that's expected to fall down to 20% or less. And so that could be the threshold then that is enough to get it over the line with lawmakers. A big question, though, of course, is this going to be enough to satisfy Beijing as well?
Yeah, because questions then arise in terms of the algorithm, what happens with that. And, of course, we also understand in terms of the time runway of this, they've pushed it back a few more weeks to December 16, I believe, for that to be able to have some more runway there.
Given that there seems to be enough progress from both sides, and we had that in the talks in Madrid, that it seems like, I mean, it's been enough, for instance, to open the door to the call this week between President Xi and Trump.
Yeah.
So that tells you it's moving in the right direction, but it needs more time, and so that's why you've got that deadline until December. It's the fourth time we've seen some sort of extension being approved. But yeah, going back to that algorithm, it's really been the key question and the key sort of sticking point. What we understand is that what China was saying after the talks in Madrid was that they would be looking maybe to license the algorithm to the American operation. So you still keep it in China's hands, but you're licensing that technology instead. That could be enough to appease China and get their sign-off as well.
Bill, fantastic. Thank you so much. Annabelle Jewellers, our tech correspondent, on the latest on TikTok and what we know so far. Okay, just ahead here in shows, we're speaking with the head of the European Chamber of Commerce in China. So they're coming out. They've come out, in fact, with a new position paper outlining these longer-term structural reforms that they see and they hope will be considered as we look ahead to the 15th 5-year plan. Jens Eskelund joins us in a couple of minutes, counting down to the open of trade in Shanghai, in Shenzhen, and here in Hong Kong. And, of course, also in 3 minutes and 20-odd seconds or so, the renminbi midpoint of the day will be very much in focus following the breakdown of the dollar on the downside. Plenty more ahead. This is The China Show. Good morning.
All right, let's talk about policy. Why not, right? Well, China is expected to announce its new 5-year plan in the next few months, outlining its social and economic development goals for the next half of the decade. Now, the European Union Chamber of Commerce in China is calling on Beijing for reforms to address structural issues, allow market forces to shape resource allocation, create equitable trade relationships, and increase access to green energy. What does this all mean? Well, joining us now is the Chamber's president, Jens Eskelund. Now joining us. Jens, it's always great to have you. It's a lengthy position paper and certainly one that you need some time to really digest. But walk us through kind of what European businesses are hoping for this time around.
Yeah, thanks for having me. I think that, as you mentioned, there are numerous areas that we want to focus on. Looking back, we think that China, in its own optics, have been quite successful in sort of boosting self-reliance, its focus on manufacturing and climbing the value ladder. But it's also clear that this heavy focus on industrial policy, on supporting manufacturing, has led to both overcapacity. We have this term in China, involution. We have seen massive waste in several industries, whether it's automotive, electrical vehicles, solar panels, wind turbines, electrolyzers, and so on. And then, of course, we have also seen how these imbalances that are growing in trade are creating friction with trade partners, and, of course, most notably with the United States. So we think the time has come now and to recognize that something have been working pretty well, but also that it's time now to change track. You need to begin to address some of these outcomes that no longer produce positive outcomes for China, for businesses in China, and frankly for the rest of the world. And that is what we are trying to do in a constructive way, trying to put forward ideas to what really needs to happen in order to address overcapacity, involution, waste, and also trade tension.
So Jens, what's the, we were, talking about this during the break, a bit of banter, of course. It's 300 pages, and it's meant to really get the attention of people who are actually drafting this 15th 5-year plan, which, to your point, right, has consequences beyond the 5-year plan itself. There are things that, side effects, for example. So what would be the most urgent structural ask based on how the 14th 5-year plan worked out, and what do you think should be in the next draft version of that?
Yeah, we think it's pretty urgently needed that you begin to look for different drivers of growth. We have seen this massive reallocation of capital from real estate and into manufacturing, which frankly in many industries there's no need for anymore. So we need to look for other sources. We think that services, for example, is an area we can see that services as a proportion of the economy is much smaller in China than it is in comparable countries. We have also seen, both at the National People's Congress and later on, that there's a lot of focus on the demand side, right? How do you sort of create consumption growth? But our point is that consumption growth is simply not enough. You need to look at the supply side also. And what we have seen and what we think is one of the root causes of these 3 consecutive years of producer price deflation is that simply you have had a supply growth, a manufacturing output growth that consistently is higher than the growth that you have in demand. Actually, there is demand growth in China. We see consumption growing actually at a healthy clip. I think retail growth was 4.6% for the first half. The problem is output. Supply is growing even faster. And as long as supply continues to grow faster than demand, then we're not going to get out of this deflationary cycle. So something needs to happen. And one area is both, address sort of the low level of services in the economy and maybe also reduce the need that Chinese family feels to sort of have precautionary savings at the levels that they have today, because the money is there. People are just not spending.
Yeah. Where does trade kind of and tariffs fall into that, Jens? Obviously, there's been pressure from President Trump to urge Europe to slap 100% tariffs on China. What would be the equitable trade relationship then?
Yeah, I think it's a very good question. I mean, I joined the show 2 years ago, and we talked at that time that trade was a slow motion traffic accident. I think the traffic accident is here right now, at least when you look across at the Pacific. If we go back right before the 14th five-year plan, China accounted for 31.9% of all containers exported in the world. 31.9% is already a very, very high proportion. The latest data that I have indicate that China accounted for 37% of all containers exported in the world. I think at some point gravity sets in, and countries around the world will begin to ask themselves, how much more can we actually absorb? And we think it's very important that China begin to realize that there are these concerns around the world and begin to sort of engage in discussion with trade partners. Now, we are not sort of in Europe sort of trade balance fundamentalists. It doesn't need to be euro to euro trade. I mean, we don't need to do gardening furniture and apparel and solar panels and all that. But there is a point where sort of these imbalances begin to affect economic security and the industrial base. And that's, a concern China has had for many, many years. And I think China will understand if Europe and other partners begin to have some of these same concerns. It's a matter of these countries and Europe being master of its own destiny. And it simply cannot be master of its own destiny if it's losing some of these very, very important, structurally important industries that allow us to make our own decisions.
I mean, to your point, Jens, it can't. We don't live in a vacuum, right? So what happens anywhere, we feel it somewhere else. And I think recently we've heard, and overnight we had, officials outline measures to boost services consumption, for example. So there are reforms and measures being put in place to address the demand side of the equation, which might go into addressing some of the more global issues. So my question for you now is anti-involution. You talked about that. What are your members expecting to come of that exercise, and in which sectors specifically are you starting to see, if any, profit margins start to improve?
Yeah. What we see actually is that overall, we don't really see a great margin improvement as a general observation. What we are seeing also on basis of some of these sort of demand supporting measures is that a number of our members have been able to grow their top line. So at least, I mean, that has sort of been arrested. And, we did our business confidence survey in May, and already there it was reflected that when sort of we look at the near term, the coming 2 years, that in general, our members are more positive in regards to growing their top line than their bottom line. One of sort of the coping mechanisms that we see is that a lot of European companies that came to China to be in China, for China, are beginning to export some of their production, because right now, in many cases, many industries, the margins that you find are better outside China than inside China. Again, our members told us 70% of them now that their margins are equal to or higher outside China than inside China. So again, exporting, whether it's machinery or chemicals, spare parts, you name it, export is a way that you can cope. That, of course, just adds to trade tension. And that's, again, where we need sort of Chinese demand to pick up and China begin to look at what it can do also to create more balance.
Jens, thank you so much for taking the time, sir. Jens Eskelund, the president at the European Union Chamber of Commerce in China. Just under 7 minutes away to the opening bell, and we're looking at these names on your screens, and you understand with the price action why we're looking at these names. We'll tell you why on the other side of this break. We're up 0.5% with the Hang Seng Index. The Wednesday session, 6 minutes and 40 seconds away. Markets rallied, same dynamic, sell side's catching up. Goldman Sachs out, raising their price targets on Alibaba, where it is now from that current price. It's caught up to that, to now 174. This is, of course, on the back of just many things, including, of course, the Q1 and QNX and latest AI models, plus, of course, just the rethinking of the cloud business and how much it's really worth at this point in time.
Yep, something that might still be underappreciated.
Yeah.
That might be the same for Baidu, according to Arete's Sean Yang and his team. They upgraded the stock to buy from a sell, and they said basically this new in-house chip venture has the potential to more than offset the struggling online advertising business, which still remains, of course, one of their core businesses as well. So talking about this Kunlun chip, where AI chips still remain quite undersupplied in China, so they already secured some purchases from the likes of China Mobile, so maybe some more upside from there.
Yeah, so the buy in Baidu has become BYE to BUY when you look at how the stock price has really come back from one that has really not given you any sort of performance. Going into the open today, and you know what? It looks like the open in Greater China might do a lot in terms of lifting the overall benchmark. We're up 0.5% going into the Wednesday session. The opening bell is coming up next. Welcome back. You're watching the China Show. We're looking at just a very long list of sectors today. So from services, given the measures that were announced yesterday, and of course they'll be unpacked even further at the briefing this afternoon. We'll talk more about that out of Beijing in a moment. There's property on the back of this Caixin report. A lot of changes in terms of analyst ratings in terms of the tech space. MS coming out with one on this humanoid robot stock rally. That's on the Tesla Optimism story. On top of that, there's several other reports out of the FT on chips and advanced making tools and I barely scratched the surface here, Yvonne, on many parts of this market.
There's a lot of AI-related news. I think AI and cloud.
That's a good way to put it.
And as we approach this Fed sort of decision, and people are saying, the thing to watch is just to be bearish on the dollar. And the breakouts that we're seeing across FX does show that maybe that adds a bit more of a reason to maybe buy up this AI trade, maybe until Jay Powell speaks, right? Take a look at what it comes to, as you mentioned, the SMIC one, which we'll flesh out in just a bit, right? But when it comes to what we're seeing right now in onshore markets, we're still seeing a little bit of pullback here, a bit of a pause here, but certainly the fact that we did see southbound flows also snapping out of 12 days of net buying does suggest maybe sentiment is, maybe stabilizing a little bit here. But we're watching very closely those chip stocks like Capricorn. We're down about 2% here right now. CATL, meanwhile, that still continues to be an up arrow story here today. But certainly there's lots of things to watch, particularly when it comes to, of course, that renminbi, right? So given the drop that we saw in the dollar overnight, we're talking already about a 710 handle cycle for the offshore rate. So maybe that means continued upside for equities, right? We talk about this virtuous cycle between a stronger renminbi, which seems like policymakers are leaning more towards, and the inflows into this equity market. Let's up the boards now. We talk about the turnover that we saw topping some 2 trillion yuan for the fourth day as well. There you go. So when we're talking about in the tech space, that's where all the action is right now, right? And once again, maybe giving Hong Kong a little bit more of a catch-up from the A-share market, because you take a look at what's seeing when it comes to Alibaba. We're up 2.5%, possibly in the back of that Goldman upgrade, talking about AI cloud is where it's at right now. Baidu as well. Look at that, 9% upside after what we heard from like Arete's Sean Yang. They basically went from a sell and upgraded straight to a buy. So up 2 notches there when it comes to recommendations, saying that, look, what we're seeing in this in-house chip that they seemingly reportedly are developing might offset what we're seeing in the core business, which remains the ad business that continues to struggle, right? And that has really been what's weighing on this stock in particular. Not to mention also when it comes to Baidu has seemed to be as a laggard in the whole AI race as well. So maybe this in-house chip narrows that gap a little bit as well. Meituan's doing still okay. We're up 1.6% here this morning. And we're talking about dollar renminbi. We're at 710 levels right now. The property space and Hang Seng, that's the key one to watch here. We are seeing a bit of red in some of these developer names here. We're looking at this Hong Kong policy address from John Lee later on. Everything from maybe property measures, a so-called property connect, maybe lure more cross-border sort of buying of property. That certainly is one key thing to watch. Things to maybe create a whole AI tech hub here are some signs of what people are anticipating, at least from that policy address as well. So certainly that's one to watch. Chip makers. So once again, we talk about SMIC. So according to the FT, they are trialing advanced tools for AI chip making here. So this is what we're hearing in terms of deep ultraviolet lithography machines. That's what they're talking about there. SMIC, there you go. We're up some 1% here right now. Mixed picture across some of them, but mostly higher, like Hua Hong Semi here to say. And we talk about, of course, consumption. Stimulus, right, in the services sector, right? So what we heard a little bit in this sort of announcement was there's no funding, there's no additional sort of subsidies per se, but really it's more about building the infrastructure, or at least helping in terms of the budgets for infrastructure for the likes of sporting, for the likes of entertainment as well, and maybe helping some of these banks in terms of loaning to some of these companies. So you are seeing a little bit of upside for the likes of Anta, leaning CTG's, China Tourism Group today, Dave.
Yeah, extending the operating hours of museums and some tourist sites, and perhaps also hosting some sporting events, which is really something that was flagged already as some key sectors to help bolster. And we'll have more on that in a moment. But just before that, too, just to go back to the Baidu story, can we get that up, please, if we can? Thank you. So I'm now looking at volumes. First, barely 5 minutes into the cash market session. We've now topped 6.5 million shares traded. We're now up, was up as much as 10%. We're now the highest since, let's call it 2 years now in shares of Baidu. Get this, we're up over 65%. I'll be generous here from the bottom that we hit late last year, I believe, is the bottom, was the most recent bottom on that. Okay, actually, no, correct myself. The bottom was in April of this year, similar to the one we had in January and in November of last year. Okay, on the services front, so 3 p.m. today, set your alarm right now. That's the briefing. That's the time the briefing will be starting, of course, on these measures to boost consumption, wide-ranging measures to aid, of course, services specifically. Let's bring in John Liu out of Beijing, our senior executive editor, to help us understand what was announced and really the context of all this. John, good morning, and thanks for coming on the show. Yeah, take us through the key measures there.
The way I describe these measures is, you have a supply side of services and you have the demand side of services, and what we got were measures to help the supply side, right? Bank lending to companies providing services, helping various companies to expand their services. You were talking about extending the time that museums are open, things of that nature. What we did not get, we didn't get any additional subsidies. We didn't get more fiscal spending to fuel the consumption of these services, and I think that is what everybody's waiting for. As you mentioned, we have this press conference this afternoon. I would say there's obviously a lot of excitement. There's a lot of anticipation for what new stimulus measures Beijing may announce. I would strike a note of caution about this 3 p.m. briefing this afternoon. The most senior official that we understand will be at the briefing is a deputy commerce minister. You'll remember, David and Yvonne, that that big press conference that we had at the end of September last year, that was headlined by the central bank governor, the head of the CSRC, so much more senior bureaucrats and officialdom. And that, I would also note, that press conference was at 9 in the morning, so ahead of the market open. This press conference today will be happening after markets have closed.
Yeah, the timing is interesting. For
That's
one
good
thing,
context,
John,
too,
it's a good point. Can you tell us a bit more why no subsidies this time around? I mean, we certainly saw that in the trade-in programs and really when it comes to goods purchases. But why do you think they're hesitant to really unleash these subsidies in the services sector?
So to be able to push out new subsidies, to do things on the demand side, it's a lot more complicated because then you have various ministries. You also have to figure out where the money is going to come from. And so that needs the finance ministry to be a part of that process. It also needs support at the local level. So you have all of these provinces across China, each of which are in vastly different situations. You have places like Guangdong and Shanghai and Zhejiang that are relatively wealthy, while you have other places like Guizhou, Yunnan that are relatively strapped when it comes to financial resources. And so it gets to be really complicated when you want to announce something nationwide in terms of subsidies, vouchers, that sort of thing.
John, just a quick note on property, and we understand regulators have lifted these curbs on foreign firms investing into the real estate market. What do we know about that, and how big of a deal is it at this point?
So the State Administration of Foreign Exchange made this announcement late on Monday, and there was a ban put in place many years ago when the property market in China was very hot. That banned foreign exchange income through the capital account being used to buy properties that were not meant to be lived in. And so they've removed that ban. Obviously, the property market is in a much different condition at the moment. There's also some, there's some details here that are not very clear. The ban was for foreign exchange income under the capital account. It's not clear whether this means people can bring in foreign exchange specifically for the purpose of buying properties. And so there's a bit more nuance there that's not clear at the moment. But I think overall the message is clear, which is the central government is trying to find ways to help create demand for properties.
John, thank you. John Liu joining us out of Beijing there. As we've been talking about when it comes to the consumption space, and certainly when it comes to these food delivery wars, it's a great piece on the terminal that really talks about the cost of really engaging in this battle. Because when you take a look at the earnings reports from either the second quarter or the first half, you're starting to see when it comes to the trade-off that a lot of these restaurants have, right? On the one side, they have to do and fulfill all these online orders, but then again, what gets suffered? Well, the dine-in sort of experience, right? And it really does impact foot traffic, right? So you focus on some of these dine-in restaurants, so I found dine-in focused restaurants like Hai Di Lao, for example, right? You gotta almost kind of have hot pot in a restaurant, right? Look at how same-store sales have fared for the first half, right? It's actually been single-digit to even double-digit declines when it comes to those same-store sales growth here as well. If you look at things like table turnover rates, for example, that's a key measure of foot traffic as well. That also either dropped or remained flat. So it's like, they're spending so much time on fulfilling these orders, people kind of using their subsidies, using all these incentives to order on these apps. But then again, the restaurant side of things does suffer, right? You take a look at like Luckin, for example, which has been actually benefiting. The first half they posted double-digit sales growth thanks to these online orders. But when you take a look at what the earnings suggested when it came to delivery costs, that surged by 175%. Right? And it makes up, I think, a fifth of their total revenue here right now, which has been a substantial rise from just a year ago. So certainly they're putting a lot of money into actually continuing on these food delivery sort of wars, right? But, what happens if you don't take part in it at all? Well, case in point, look at Chagi. This is, of course, the Starbucks. They want to be the Starbucks of tea, right? Listed in the U.S. just recently. But what they did was they said, we're not taking part in these food wars. We have a premium product, right? But what happened to the stock? So you take a look at that. I mean, basically, once they announced those second quarter earnings, where we actually saw where same source, their profitability actually take a hit from not taking part, right? We saw second quarter sales go slow to 10%. The stock basically declined about 25%. So it almost shows, Dave, that there is no choice but to actually take part. But in what degree?
Yeah, the lesser evil is dig into that cash pile that investors have thrown your way.
Yeah.
Protect your market share. Otherwise, that happens to your stock price there, right? A fantastic piece that has been outlined for us here by our team. In fact, for our subscribers, you can get more details on the story and all the moving parts and all the graphics and really interesting data points, right?
Yeah.
So empty tables, lower margins, and what you really give up in terms of actual real estate in your physical store in favor of what, thinner margins? It's it's almost a choice between lesser evils here, Yvonne.
And it's forced them to kind of evolve, right? I think Heidi Lau is like, I got to do more, single solo sort of packages when you're ordering online, right?
Yeah.
You can have like kitchens delivered to your house.
Yeah.
In some ways, just to offset what you're seeing is less foot traffic.
I never got the point, though, of having hot pot delivered. Isn't that the same as going to the grocery?
It happened during COVID, though. I appreciate it during COVID, right? When you miss some,
they bring everything,
some
though.
mala, everything.
They bring
It
everything,
works,
yeah. I thought they just brought like raw materials from the grocery and just go
cook it yourself.
Cook it yourself, which is kind of the same thing. Anyway, I'm a big fan of Heidi Lau. You can see me there actually quite regularly. Yvonne knows this. Okay, equity markets. All right, we got slightly off track there. Not off track are equity markets. In fact, we've fully reversed 4 years of losses now on the Asia-Pacific benchmark. In case you missed the news this week, we hit a fresh record on MSCI Asia-Pacific. Now, here's the issue, though. Some of the big funds, with this exuberance that's now in place, actually are now looking at some of the risks, right? This record-breaking rally in the equity markets is actually set to come under pressure because of what's happening across, the tariff front, for example, and you look at the risks out there. In fact, let's bring in Yukyung Lee, our stocks reporter, to help us understand the connection between the record rally, Yukyung, the tariff front, and what the earnings risk that isn't quite visible, I should note right now. Put that all together for us.
Yeah, sure. So with my colleague, we asked the major funds in Asia, including BNP Aberdeen and Franklin Templeton, what are the risks that markets might be underestimating? And they said the tariffs potential impact on earnings are actually the ones that the market is ignoring right now. And you've seen that yesterday we saw this MSCI Asia Pacific Index closing at a record high. And the index has been rising more than 30% from its April low. So it might lead to investors believe that the risks from tariffs are gone, but actually it isn't. And if you look at the earnings consensus in the MSCI Emerging Market Index, they've been going down only about 3% so far from the earlier this year. So earnings consensus don't really reflect what potential tariffs impact could be. And there are several reasons for this. One is that how much earnings will get hurt by the actual tariffs impact. It's actually really a complex math that some companies might try to put it on the supply chain, maybe like pass it through to the prices, so that maybe it could be reflected to the inflation. But it's just really too complicated to reflect on their earnings estimates. So the street consensus right at the moment pretty much don't reflect any potential risks that tariffs could have in the corporate earnings in Asia in coming months, which could only become visible after several quarters. So we're expecting companies to actually issue some guidance maybe early next year. And until then, the earnings consensus will not reflect that, which means that they have more downside risk as the tariffs become more materialized.
Okay, so obviously, I guess you're focusing on these export-oriented sort of companies. Which markets and sectors do you think are most vulnerable then when those tariffs start to bite?
Yeah, sure. So so last year Asia altogether exported more than $1 trillion of goods to the United States, and majority of that comes from China, markets like Taiwan and South Korea. And if you also look at the semiconductor tech hardware constitute a large part of the Asia's imports to the United States. And if you think about Asia, it's the center of the global supply chain for the semiconductors. So a lot of the funds that we spoke to pointed out that South Korea and Taiwan are the center of the global semiconductor supply chain, are the ones that could be most vulnerable to the potential tariffs. We also have President Donald Trump saying earlier in September that he will announce the exact rates for the semiconductor tariffs rate for the semiconductors, which could go as much as like 100% unless these companies bring the manufacturing back to the United States. So we will, I think there's still the headline risk on this headline tariffs risk to these semiconductor companies, in addition to the how the investors and analysts going to reflect that to their earnings.
Yokyung Lee, thank you for joining us from Seoul there. We got plenty more ahead. This is Bloomberg.
Okay, welcome back. Looking at Chinese markets right now, everything from onshore markets to MSCI Hong Kong, of course. This is a big policy address today, but today the story is really a lot about tech. I mean, check that out, 2.2% to the upside. But yeah, let's take it back to Hong Kong because we could potentially get a catalyst today here.
Yeah, John Lee, the chief executive of the city, is set to deliver his annual policy address in just a few hours. He's expected to focus on reviving the city's economy, including fast-tracking a cross-border tech hub with mainland China. Let's bring in our chief North Asia correspondent, Stephen Ingle. He joins us now from Hong Kong's Legislative Council headquarters. Steve, we're expecting a pretty long speech from the chief executive. But it seems like it's going to be a very kind of multifaceted approach to really helping the likes of property, for example, and maybe even the financial markets.
Yeah, so it's sort of, well, it's multifold, but the two areas that I want to concentrate on are the diversification. Obviously, here's the South China Morning Post with the headline, Lee's blueprint aims to fast-track new industries. Of course, Hong Kong has built its reputation and its strength on the property sector, as well as, of course, the financial sector. They want to diversify, and that goes part and parcel to the northern metropolis that they're proposing up on the border with Shenzhen to get policy and the economy more in line with the mainland. That's not a derogatory statement. That is the reality of Hong Kong's situation right now. Policy is being more directed to be in line with the growth engines across the border. But again, there are growth engines, but then there's also laggards. And the property sector clearly has been a laggard in the mainland, but also here in Hong Kong. Residential property down for 4 consecutive years. In fact, there was a property association is recommending that John Lee and the government here come up with a fund to help distressed properties to the tune of $2.6 billion, 20 billion Hong Kong dollars. I don't know if John Lee is going to go that far today because seriously, the issues here are multifold. The commercial property sector has been in the doldrums. Property developers as well as investors have seen non-performing loans go up, distressed assets. So there will be some sort of measures to help put a floor, perhaps, on the property market, including increasing the cap on students, non-resident students to come into Hong Kong. It's gone gradually from 20% to 40%. It could go up to 50%. You say, why does that help property? Well, families and people come in, more undergraduates, more people into Hong Kong, and they could also broaden the so-called Property Connect to get more mainland investors to invest. Already 30% of the residential properties here in Hong Kong are purchased by mainlanders. That could go up under any kind of new schemes.
Steve, thank you. Stephen Ingle, our chief North Asia correspondent, with a preview of what's to come. Of course, he's right outside LegCo there, here in the city. Just ahead here on shows, in fact, just on one of the points Steve was just pointing out, there are implications on the property sector, residential, commercial, industrial. and everything in between. Kathy Lee joins us at those times on the screens. Plenty more ahead. This is Bloomberg. Welcome back. Okay, we're about 25 minutes into the session here. Robotic stocks in focus. Emma's out. Morgan Stanley out with a note. Let me just complete that. On the up, really, on the back of this, well, the plot line revolves around Tesla's Optimism Gen 3. And not surprising, of course, this really was a trade that was just waiting for more analysts to get behind it. We are getting that, not just here, right? We're also getting that just about in many parts of the AI trade today here.
Yeah, according to Morgan Stanley, the catalysts are still coming. That's what they say, right? So it's not just the Tesla news. Obviously, the Unitree IPO progress, that certainly is one thing that they're flagging as why they're seeing more room for some of these stocks to go higher. But yeah, certainly there's a lot more new order announcements ahead, they say, in this space here. There you go. Hang Seng standing out in a good way across these markets here today ahead of the Fed. This is Bloomberg. Welcome back to the China Show. Here's a look at the Hang Seng, just a half hour into session, and yeah, looking pretty good here right now. We're seeing gains of 1% on 8 shares, or 0.75% to the upside on the Hang Seng, and really kind of bucking what we're seeing across the region, where you are seeing a pullback in markets like Japan, like the Kospi, which is down some more than 1% here right now, ahead of the Fed. So what stands out? I think tech. Once again in China. Yeah,
non-Fed related. That's the component. That's the one that's driving here today. AI story. Baidu is the one that's really leading these gains today. On the back of that, was it Arete that came out and they jumped a few places. They went from sell directly to buy.
Directly to buy.
On this one, right. So Sean Yang, if you're not busy, if you're listening here,
come on the show, please.
Pick up the phone, sir.
Yeah, see you
Someone
soon.
might be trying to call you. Alibaba, this was Goldman actually also coming out and upgrading the price target on the stock here to higher 170, let's call it that, on the Hong Kong and also the ADRs. Baidu, of course, up 11%. We're now looking at how much volume's coming through. My producers are about to help me out with this, with a number. In fact, I'm looking at my screens. We're now approaching 14 million in the first 30 minutes of trade, which is, thank you so much. There we go, 13 in about 28 minutes or so. NIO is actually also a call coming out of UBS here.
Yeah, it's an interesting one, too, because the ADRs gained some 8% on the back of what this UBS analyst says. So they're saying consumer confidence is looking a bit better. So restored, they say. This recent $1 billion share sale that strengthened his balance sheet. Also, when it comes to narrowing that gap, when it comes to that valuation discount with Xpeng, they said that could happen given these improvements. So that's why we're seeing the stock up to 8% right now.
Yeah, in case you missed that, not to be a bummer here, there's that small story in Xpeng. I think one of its flying cars caught fire. I think it was yesterday. Anyway, I'll clarify myself, and I'll look at more details on that in a moment. Okay, the other big story is on the... Well, I think there's a Fed conversation, right? Yes, they're coming up. Almost forgot about that because China's giving us a lot more to talk about beyond, of course, Powell and friends. Here you go. The dollar index broke through the low in July, and we're now trading at 11.8 handle takes you back to 2022. Euro implieds are up ever so slightly. That's more than half. That's, of course, overnight, so that reflects, of course, potential gyrations in the dollar. Similar move that we're getting in dollar yen. And, of course, as you can see now, we're priced almost to 70 basis points by the end of this year. That takes you into, I think, 1.5 cuts. No, 150 basis points of easing going into, I think, the bottom of where the market's pricing by the early of 2027.
Yeah, I love the Wall Street Journal has a great kind of preview piece on this. They're basically saying it's going to be one of the strangest Fed meetings in years. I mean, the cut's going to be pretty straightforward. Right. I think it's really just the divisions that we're seeing within the Fed right now. When you have Lisa Cook that's going to be there, you have the likes of Stephen Miran that are going to be there as well. Yeah. They really talk about the weirdness right? Because for one thing, Jay Powell doesn't even know what's going to happen to him after his term is up as well. Who's going to succeed him? So, yeah, it's going to be a weird one.
Well, it sounds like a reality show that I would love to be there.
I think John Authors wrote a whole column of it. To be a fly in the wall at this Fed meeting.
Yeah, to really help us understand. It's almost as if it's not about the rate cut itself.
No.
I want to understand what the almost a singles inferno sort of thesis is there as far as the tension that builds up in the room as far as that's concerned. The tension's really been building on a lot of these charts. We've been range-bound on many in the G10 FX space up until 48 hours back, and we've seen new highs on many of the currencies. Aussie, you have the euro, you have yen to the downside 146, and of course dollar index, we just talked about that. David Finnerty is with us right now, our FX and rate strategist, to help us understand. David, this break below this key level on the dollar, does that open up further downside here on the greenback?
Certainly traders are betting for it. It was quite interesting yesterday. Normally you don't see a lot of activity ahead of Fed decision. People wait to see what happens. But certainly in Europe yesterday, a lot of hedge funds were very happy to buy dollar put options, which is basically options that the dollar will weaken against a variety of currencies, including the euro, yen, Aussie dollar, were all three very popular. So those tenors were basically 1 to 3 months. So basically into year end, shall we say, the market is expecting or looking for or betting on, however you want to put it, on the dollar weakening further. Obviously, what happens today, later today, with the Fed decision will have a key impact. They'll be looking at obviously not only the rate cut, but that Fed dot plot, how many rate cuts do they signal for the rest of this year? And also they'll start looking at next year as well. You know, how many do they start indicating next year? I say indicating because these dot plots can shift quite a lot between every quarter. So really the December one will be of huge interest for next year. But I think certainly this year, they'll start looking at this year and next year's projections or estimates for rate cuts.
Yeah, talk us through the dissents, right? It seems like Powell's going to probably have to deal with a lot. From the one hand, it's some of the more ones that are loyal to Trump that might say, look, the labor market is showing real cracks. And then the other side, you have regional presidents that might say, look, I'm scared of tariff pass-through when it comes to inflation, which still remains well above the Fed's target.
Yeah, I think this one's going to be very interesting. If you go back to the most recent dot plot back in June, there was quite a few Fed governors and Fed presidents who were saying 0 cuts this year. So obviously you'd have to guess that they've certainly changed their stance to become a bit more dovish. Now, I think the question is how much? I mean, how much is this dot plot shifting lower in terms of more rate cuts? And I think that's going to be quite telling. We know there's been lots of pressure from President Trump to cut rates. We know Stephen Miran has come in, so he's one on the dovish side. We know people like Christopher Waller is already dovish. But there are some other people out there, like Muslim and say Bostic, who are still like, yeah, look, we may do cuts, but we're not going to be too aggressive yet. We don't quite see the data yet to warrant several cuts. But, you know, those tunes can change. So I think that dot plot, particularly the upper boundary of, you know, what's the fewest amount of rate cuts, will be very interesting to see in the market be looking at that. Because if a lot of people were going no, suddenly go 0, suddenly go to 2, then you go, well, that's quite a big shift in 3 months. And the question is, well, 2 can go to 3 to 4 very quickly as well. So the idea will be that the Fed's overall stance, even these ones who push back on Trump cuts, they are coming round to his way of thinking. For whatever the reason, whether it be the data, whether it may be peer pressure, maybe a combination of both. You know, the question would be, the Fed has it become a lot more dovish overall? And if it has, the market is very happy to price in rate cuts if given a chance. And they will certainly duly note that if the hawks have become a lot more dovish, then the Fed overall has certainly become more dovish moving forward.
David, thank you. David Finnerty there, our Bloomberg FX and rate strategist joining us out of Singapore. Let's bring in Julie Ren now, Bloomberg opinion columnist. She thinks the dollar will get a lot weaker with Stephen Miran joining the Fed. She joins us now. You said in your column today that this is the decade for EM. I mean, EM has basically been unloved for the past decade now. What do you think is really changing that landscape, and why Stephen Miran is going to change that?
Well, the EM asset class is very much tied to the dollar, right? Like if the dollar is very strong, dollar-based investors will demand excess returns to offset their FX losses. And then, and interestingly enough, the dollar actually goes through major cycles with the boom phase and the bust phase going through like a decade. The latest one was basically roughly from 2010 to 2022, right? And it seems like with Stephen Miran and then we not knowing who will head the Fed like by next year, it does seem like Trump is having more influence on the Fed and what they want. The Trumponomics people want, what they want is a much weaker dollar. And it does seem like we are setting the stage for a decade-long bear run in the dollar, which necessarily bodes well for emerging markets.
Right. And is that an equity play? Is it a play on the carry, for example? Do I look back at high yield? I mean, the U.S. dollar is now high yield, if you think about it. But yes, what does it mean for EM high yield?
Yes, there is definitely equity play, like what we have seen in the Hong Kong stock market, right? Like the Chinese tech names are playing major catch-up because, first of all, the dollar headwind is gone, right? And the geopolitical headwind is kind of gone as well. And also, like the so-called good quality carry trade EM currencies, like the currencies from Mexico, Brazil, and South Africa, they have been doing pretty well lately in the last 3 months because of the carry.
So you talk about Miran. Of course, he's a controversial sort of figure here. He is only one of 7 members on this board. So I know he's made comments about interest rates and the such. Other than saying that the president has a really good track record of being right on monetary policy, will he really be able to reshape monetary policy, you think?
Perhaps limited, but Trump has other chances. And I think it's the market narrative that matters, right? Like people are definitely paying attention to what he's saying. Like he even talked about control the yield curve on the long end. That's a form of yield curve control. And like global asset managers, they have been diversifying. Like the fact that the gold is up 40% this year says something, right? Like gold is on track to become the biggest asset reserve for central banks, right? And also, like what you see is international diversification into European stocks and to less extent Chinese stocks. So it's less about how much change he can really make, more about the market narrative.
More about that third mandate, as you mentioned, right?
Yeah.
Moderate low interest rates in the long end.
Yeah. Yield curve control on the Fed. I thought we were done with that with the BOJ. Okay, I think we're just getting started here. Shirley Ren, thank you so much. By the way, you can catch and read Shirley's column in full here on the terminal. It's also on Bloomberg.com. There it is on your screens, right there. We'll continue this conversation around the implications on broad asset classes and why gold just seems to be divorcing from every single theme out there and just embracing every single other theme out there. Yeah, a chameleon in the form of a long trade. Plenty more ahead. This is Bloomberg. Welcome back. You look at this chart on your screens, you don't think there's a lot of ills in the world. We erased 4 years of losses this week on MSCI Asia Pacific, and it's not just this, right? Everything but the dollar is up this year, and I think that's really the conundrum right now. So when everything is up, what do you buy? Let's bring in Stephanie Leung, Chief Investment Officer at investment platform StashAway, to just help us guide how we should be thinking about this everything rally at this point.
Yes, indeed. I mean, everything is rallying. Even the most hated kind of asset class bonds have started rallying. So I think basically, of course, we'll have the Fed decision quite soon. The market is looking for 25 basis points and another 25 basis points into year-end. But I think what the market really is perhaps looking beyond the immediate Fed cut. If you look at kind of next year, I think the market is saying that, okay, we're going to get a replacement of Powell, and Donald Trump is going to get whoever he wants to pick, and the Fed will tend to be dovish. And that's a very, very good scenario for risky assets. Hence, I think that's why you're seeing kind of this everything rally.
Yeah, the bond market, as you say, has also turned positive,
yes.
Right? I take a look at the 2-year yield in the U.S. It's basically fallen some 20 basis points in the last few weeks or so. We had a guest yesterday say that's the perfect case to go long duration. Is there anything wrong with that sort of trade?
Well, I think, if you compare all the asset classes that we can invest in, duration is something still that we least prefer. I think you long duration when the economy is weak, right? When the U.S. economy particularly is getting into recession, that's when duration actually outperforms all the other kind of options that you can have. But I think if you look at the U.S. economy, it's been sort of like a two-speed thing. So I think on one hand, of course, the cyclical side has been suffering, not too bad, but it's not been doing great. But on the other hand, if you look at technology, if you look at financial services, these have been doing very, very well. So the services side of things is actually helping to hold up the U.S. economy. I think there's been a bit of weakness in the labor market if you look at the most recent kind of payroll numbers. But still, I think on the whole, unemployment is still at 4.2, 4.3%, which is still very, very low. So I think on average, particularly if we go into a Fed interest rate cut cycle, looking forward the next 12 months, I see very little risk of a recession, and that's not a scenario where you want to be overweight duration. So I think there are better options out there. For example, we've been talking a lot about gold versus bonds in the past year and a half or so, and our view is that you want to be overweight gold versus duration, and so far that view has played out. And I think going forward, I think that trade is going to continue.
Looking at how the gold price is behaving, what kind of asset class, what kind of asset do you think it is right now? Like, what is it telling you about how the market's looking at the role of gold? I
think that's a very good question, because if you look at gold, at different periods or during different regimes, people look at gold differently. Sometimes there's always an excuse to buy it. Sometimes it's an inflation hedge. Sometimes it's U.S. dollar replacement. I think if you look at this year, so of course, at the beginning of the year till April, gold rallied about 30% up to kind of 35 on the back of the fear of U.S. dollar weakness. So if you look at gold from that angle, it's sort of like a U.S. dollar replacement. Now, that made sense. Today, U.S. dollar is quite stable. Still, gold managed to break out to all-time highs in recent weeks. I think that narrative has probably shifted to, okay, gold is also a replacement for bonds. So if you're not getting, I guess the trade-off is that if you invest in bonds or if you stay in cash, you get interest rates. You get like 4% payout every year. Whereas in gold, you don't get that. So that's another trade-off. But with the Fed due to start to cut interest rates again, the attractiveness of staying in cash or in treasuries become lower compared to gold, because the interest rate that you're giving up is lower and lower. So I think that creates another kind of tailwind for gold. Of course, I think underlying all this is where's the demand coming from? And we've seen very, very persistent demand coming from central banks. Central banks have just been keep buying gold for the last 2 years, due to a variety of reasons, and I don't think these reasons have changed. Of course, this year, what's added is resellers coming in, so we're seeing kind of more extended positioning in terms of futures or options that potentially create some more volatility. But I think over time, the key reason for buying gold, which is basically fiscal dominance globally, I think that hasn't changed.
Well, it was always nice just to nice have, right? It was always at the fringe. Allocation to alternatives like gold was always, 5-10%.
Now it's must have.
It's must have. And so I guess now does it necessitate a higher allocation for regular portfolios, is my point.
I think, for example, at StashAway, it's a must-have for us, but you'd be surprised how many people still don't have gold in the portfolios, right? A lot of people think that, gold is for a niche investor. I think that has, of course, started to change. I know, for example, some very big family offices are having sizable allocations to gold in many different ways.
Yeah, well, they're rich anyway, but yeah. Okay.
Yeah, exactly. But I think for a lot of even institutional investors, that's not a required allocation. But I think, as you said, that's going to change, and I think that drives further upside for gold in the coming years.
China stocks continue to also rally.
Yes.
Almost everything in some ways. What can I still chase in this market?
I think perhaps, if you think about globally, what's been driving markets is, of course, liquidity. And we were slightly worried about global markets kind of about a month ago, because the Treasury General Account, the TGA, has to be refilled. And typically that has kind of led to lower liquidity. And now, actually, fast forward 2 months to now, that's been kind of half filled. But we've seen some consolidation in markets, but that's still going strong. What I think is potentially going to happen with the Fed cutting interest rates is that the rotation from kind of U.S. big caps to other markets will continue because there is expectations that rate cuts will benefit smaller, small caps, for example, broader parts of the economy, even emerging markets. And China, being, of course, a very important part of emerging markets, will benefit from that. Of course, with China Tech, there's the added AI story. I think we've had the DeepSeek moment in Jan. I think right now we're sort of having like a Alibaba AI moment by them saying that they're developing their own AI chips. And I think most notable, if you go into details, is that what they're saying is that their AI chips will be able to run on CUDA, which is NVIDIA's software platform. What that means is that for companies that want to shift from NVIDIA into Alibaba AI chips, it's very, very easy because they don't have to rewrite the code. Whatever code they've written for NVIDIA stack actually also works on Alibaba. That was not true for Huawei. Right? Huawei never said that they were built on CUDA, but I think that's quite an important inflection point. I guess that's why the market is sort of getting excited about the China AI story.
Yeah, and the bar seems kind of low to impress markets. Anything on AI, any good news, and not to dilute, of course, the good news out there. But isn't that a sign, an early sign of overexuberance? That anything almost impresses people these days?
I mean, Sam Altman himself said we may be in a bubble. Yeah, but he is part of I guess he's part of why that bubble exists because I mean he's saying that OpenAI is going to invest 115 billion over the next few years in AI infrastructure. And that benefits like the whole ecosystem, and that's just one company, OpenAI. If you think about like all the companies in the U.S. and even nations like China, Europe, U.S., I mean that's added to like significant part of the GDP. And in fact, if you look at this year, a large part of U.S. GDP has been driven by tech AI investments. So where does that money come from? That's a big question. And I think as long as the Fed keeps liquidity kind of loose and I mean the money engine keeps working, I mean that liquidity is going to continue to fuel the bubble. So I think going back to our first question of like where the Fed is going and why the market is rallying, I think it's kind of going back to that first principle of liquidity in the system.
Stephanie, thank you. Stephanie Leung there, StashAway CIO, joining us there on this everything rally. We got plenty more ahead. This is Bloomberg. Here's some stories that we're tracking for you today. U.S. auto safety regulators are investigating whether Tesla's electric door handles are defective. It comes days after a Bloomberg investigation found a series of incidents in which people were injured or died because they couldn't open doors when Teslas lost power, especially after crashes. Now, regulators have received more than 140 complaints since 2018 related to Tesla doors getting stuck or malfunctioning. Disney, Universal, and Warner Brothers are suing Chinese AI startup Minimax for allegedly pirating their intellectual property. The complaint targets the video and image editor Hailuo AI, which offers images and videos that feature copyrighted characters, including Spider-Man and Darth Vader. Minimax is one of China's so-called AI dragons and is aiming for a public listing as soon as this year. ThyssenKrupp shares rose in Frankfurt after it revealed a takeover offer for its struggling steel unit from India's Jindal Steel. The German firm says it will carefully assess the non-binding offer without disclosing its size. It's the latest chapter in the company's drawn-out search for a buyer of its steel division.
Right. Let's have a look at these markets right now. And yeah, I mean, we're looking at a lot of things. So you mentioned Tesla. I think we'll look at XPeng a bit later on. Of course, I mentioned this at the top. that one of its flying cars actually caught fire at a rehearsal for an air show in China. The stock's not reacting so much as far as that's concerned. Speaking of what is moving, and of course this is really on the back of this plan, and we'll get more details on this later on, is this plan to boost consumption, the measures there, travel, services, we're looking at that. Change the page, please. Minerals, miners in Oz and also in China. This is really on the... Oh, no, we'll get to that later. SMIC, this FT reports. Can we change it back, please, if we can? SMIC, my apologies for that. I just brushed through the page quite quickly. This is going to be interesting to see how this actually evolves and whether or not they're able to do this. Trialing advanced tools for AI chip making. So think lithography. That's really a big missing piece, not just in China, but everywhere else in the world, except maybe the Dutch. Rare earth stocks in focus, Aussie and China on your screens. Bottom of the screen says tell you why. This is Bloomberg.
.29 a.m. in Tokyo. Japanese markets are going on a lunch break in just a moment, and we are seeing, slow but modestly higher when it comes to the Nikkei 225 ahead of that Fed decision. But yeah, we also have to brace for what? Another bond auction, right? The 20-year yield. We always say it's going to be a tough one, but what's interesting this time, Dave, is that it's the first test of demand, particularly in the long end, after the Prime Minister announced his resignation, right? And of course, some of the successors, the people that have been talking about vying for the job, have been more in favor of expansionary fiscal policy. So maybe it could be a little bit more tougher than usual.
To get this off. Well, here we go. We say it again.
All the time.
We say it again. I mean, we work in news, right? So our inclination is really towards bad news. I'm kidding. Come on.
The cynics in us, but no.
Yeah, but you know what? Interesting, because this time yesterday we were trying to figure out what the JGB contract was actually on the downside. And we now understand, perhaps given what we've seen, there is downward pressure on fixed income, higher on yields because of the politics in there, right? So apart from that, we're looking at chip stocks. This really goes back again to the Morgan Stanley note. If you like disco, we're not talking about the dance clubs of the 80s. This is your top pick as far as chip-making semiconductor equipment is concerned. That's Morgan Stanley's top pick, and continuing to rally going into the session today. Right, apart from this, Asia-Pacific, vols actually down. Volumes are picking up here in Hong Kong. There are three things at play. One is this AI play on Baidu and Alibaba and everything that's going on there with Morgan Stanley and the Goldman Sachs note, respectively. Number two is the consumption services briefing that's taking place later today. And, of course, here in Hong Kong, which is a T1 typhoon signal, in case you missed that, is probably set to be hoisted later today. We'll see. We'll see. That's weather dependent, quite literally. And, of course, this policy address in about 29 minutes from now, if they start on time.
Yeah, it could potentially be a major event, right, to watch here in the city today. And yeah, as we talk about what's going to happen at the Chamber of Legco, that's where our very own Stephen Ingle is right now. There's a lot of chatter about what this policy statement is going to say, everything about maybe it's a multifaceted approach to really help the property sector, financial markets. There's talk of maybe trying to at least build this AI sort of tech hub here in the city as well. So there's a lot to unpack, really, on what we could see, just given as the economy shows tentative signs of recovery. Let's get to our next guest here. Collier's head of research and retail consultancy, Kathy Lee. She's been advising industry groups and business chambers on the government's plan for a northern metropolis development. We'll talk about that in just a bit. First of all, what are you expecting out of this policy address in terms of your wish list?
Our wish list, I think, we would like to see the government have more insights or more policy helping the industry to grow, especially when we have the metropolis the plan at the moment. So we want something really make that plan happen, making it a move forward, because there's a lot of noises, a lot of concern in the markets, how we can help an industry actually moving into that a huge land of Hong Kong.
What are the sticking points? Why have we yet to see a lot of momentum? Because I've heard that phrase a very long time. The reason I remember it is because it's quite long, too. It's 6 syllables, right? Northern metropolis. But yes, what would you like to hear? Because you're part of some of those conversations.
Yeah, I think there are several points. First of all, I think the infrastructure, the timeline of the infrastructure, to getting into the area is one of the major concerns from the private market. So I think the government already try to make it working faster, working with MTR, or even introducing new infrastructure contractor, construction builders or partners into the Northern Metropolis to help to facilitate or fasten the infrastructure development construction in that part of Hong Kong.
Okay.
And then the other point will be the land price. So, at the moment, the interest rate is still high. A lot of the developers may still have some situation on their financial books. So I think the land price, how the government is going to dispose the land in Northern Metropolis will be one major area to increase the interest. If the government, really want to develop, the IMT industry or the education sectors in the Northern Metropolis, they have to think about using the industry-led development mode. Rather than the previous, the highest bidder to get the land. Now they need to, grant the land directly to some industry players, industry cooperation to help the industry to build in that Northern Metropolis.
What are you hearing about Property Connect? I mean, this is something that there's a lot of market chatter that the government wants to ease the flow of capital here so that you can buy up properties here and unleash this Chinese demand. Would it work in turning around this property market?
I think it's slightly different from the stock market because the stock market is not connect. It's kind of like an enclosed system.
Closed loop, yeah.
Yeah, closed loop. You can control the capital inflow and outflow within a governance system. But if you're doing in the property sectors, so how about the rental, income generated from those purchased property, investment properties, and how about the vendors sell the land? Sell the properties. So how they control the capital actually going back to mainland, and then I think this will be one major concern from the mainland governments. So that may be a little bit difficult to actually implement.
Not for now.
Not for now. They need to more time to investigate, to explore, what will be a workable situation or workable system to control the capital inflow and outflow.
Okay, so you've outlined some of the part of your wish list, which is, give us something more in Northern Metropolis. Maybe not this one on the Property Connect. What do you think is realistic to expect from today's speech?
I think if we really want to attract more mainland interest or capitals into the property markets, to relax the cap for the capital investment entry scheme may be one way to help. Previously, the government already increased the cap to $10 million. Now there may be some insiders say that there may be possible relaxation to $30 million. So that will help not just the luxury residential market, will be in other commercial properties like the retail shops or strata title office that will arise in other levels of investment interest into the property markets of Hong Kong.
How big of a force are mainland Chinese buyers now in the property market here in Hong Kong?
Actually, we do see quite a lot. Some of the major deals, I think the top 10 deals we recorded in the past months, at least 3 to 5 of them are coming from the mainland capital. Okay. So the founder of Meito Shoushou, he invests in 2 on-board semi-retail properties in Hong Kong. And also we have seen a lot of interest and inquiries even in the luxury residential market as well. So we see this mainland capital returning back into Hong Kong.
Is that a bit of a risk, like a concentration, relying too much on Chinese consumers to save this property market in some ways? But we've tried all certain tools, right?
Yep.
Stamp duties have been eliminated, and yet that hasn't been enough to really turn around this market.
I think we are not just focusing on the mainland, because for the capital entry, investment entry schemes, it's open to the rest of the world. So everyone interested in coming into the Hong Kong, they can apply. And also the government just have a new policy announced in July about the student accommodation. Yeah. So converting commercial property into student hostel, try to help to provide more supply because we have more non-local students coming into Hong Kong. And I think almost 2 months after the government's announcements of this a new policy, we see a lot of interest, not just mainland capitals. We see overseas, US, UK, or even Australia, because that this student accommodation sector is very well established in the UK, in Australia. Yeah. So investor and operator in those markets now seeing opportunities here.
You need more dorms.
In the dorms?
You need more dorms.
Oh, yeah. Well, if we don't have more students, right?
Yeah, you can afford rent here.
You've had a lot of experience in planning retail projects.
Yep.
Right? And the reason I say that now is there's this new trend, we know this, of course, of going north. Does the government need to be more active in being able to strategize the use of retail projects, commercial projects in the city? How does Hong Kong now fit strategically because of this Greater Bay Area project? And do we need to hear that from the government?
Yeah, I think they need to provide some sentiment or incentive, like for locals and also visitors to be spending in Hong Kong. Maybe like, the spending consumption voucher may be one way to go to enlighten, the interest of local people, like to get back this local consumption. And then the government already have done a lot, like those mega events, those, sports, and attract a lot of visitors recently. I think keep going in that way, that will help. And also the yacht, is another new economy driver. Yeah. So that will also help to attract, new stream of visitors coming into Hong Kong, like with the yachting clubs and those things. I think we are on the right track. So just keep doing what we are doing well now, and then that will help.
Okay.
Residential, office, retail, where do you most optimistic about? And what's the outlook for maybe all three now?
I think retail will be possibly among all those sectors, recover faster, because office market we still facing the challenges of high vacancy rates and then a lot of supply. Yeah. The supply pipeline should be slowing down after next year. So the government already stopped selling any commercial land this year, and then that will help the markets to have a period digesting our existing stock, and then that will help to stabilize the rental. But it takes more time. But I think there is also a new demand driver in the office market we've been seeing in the past, a year or two, is the education sector. Oh. Yeah, the universities, now they have a lot of non-local students. They need more, teaching facilities as well as student accommodations. You can see, the new university is the new, demands, they are purchasing office space, they are, leasing up spaces, or even taking up hotel as their student dorm. So that will help, to digest some of the stocks in the market as well.
Isn't there a restaurant here that recently got...
Metropole,
right?
Just got bought by Hong Kong UST.
Oh. Yeah. There we go.
Yes. More space.
Yes.
Well, hopefully a space for learning and not just pretending to read we used to do in the library back in the day. Demand for a bigger library, but just to hang out. Air-conditioned one. Kathy, thank you so much.
Yeah, you're welcome.
Kathy Lee, Head of Research and Retail Consultancy at Colliers. By the way, big one coming up in 20 minutes' time, and the policy address from John Lee. Subscribers on the Bloomberg terminal can check it out. This one, Tia Live Go, is the function that you run, and maybe the blog is ongoing, not yet, if not already. Anyway, check that out. Gearing up. There we go. That's the operative word. Plenty more ahead here on The China Show.
All right, we're checking Baidu shares here right now. Oof. We're at 12% upside here right now. So this is, of course, in the back of what we heard from Arete, their research team there, Sean Yang, upgrading that stock, right? Straight from sell to all the way to a buy.
Yep.
On the back of
That's how I got married, too. I got re-rated.
Chip venture, right? No neutral. We don't like to be neutral.
No.
But certainly that's the one catalyst there. I'm really talking about the optimism on that, and really could it actually offset what has been a drag on the stock, which is basically a struggling online ad business.
Okay. Well, should we keep ourselves grounded?
Robert Lee always keeps us grounded.
Yeah. Let's hear his take right now. Senior analyst, of course, at Bloomberg Intelligence. Okay, why don't we talk about this recent run-up that we've seen we'll start things off with one of your favorites, Baidu.
Okay, I think we need to split this conversation into two halves. We could talk about sentiment, market sentiment, sentiment towards AI. I don't need to tell you the answer. It's pretty bullish.
The share price is already telling us that.
Yeah, the share price is telling you that. So it's sort of, some might say, fill your boots in terms of sentiment. But then, back to reality, back to the fundamentals, and I'll just quote a couple of quick stats. Baidu's EPS is predicted by consensus to decline by nearly 30% year over year this year. So it's going to be a pretty tough year. And also the earnings estimates, both for this year and next, have been downgraded more than 20%. So, the profit outlook that analysts had at the beginning of the year has been substantially downgraded. Now, a bullish person would say, well, that's fine. That's all in the price. We all know that. It's going to be better next year. As we British sometimes say, jam tomorrow, right? So is this new chip going to deliver a new wave of earnings upgrades, earnings renaissance at Baidu? I don't think so. Because really what Baidu's doing alongside with Alibaba is mirroring what their US peers are doing, because there's a shortage of AI accelerators in the market, then naturally they need to develop their own. And also the sort of news that we've seen, which has maybe prompted part of the share price rally, is news that Baidu is maybe developing a new chip. You know, we don't know the details on that. We don't have real visibility on it. There is a second piece of news which is driving sentiment in the semiconductor sector for China. Sorry, I've talked too long, but so I'll just finish on this one.
Keep going.
There is a privately owned maker of equipment, so in a way, in crude terms, a Chinese equivalent of an ASML, who's supposed to be testing their equipment with SMIC.
That's the one
which
today,
is,
yes.
Yes, which is China's TSMC, if you like. They're the main foundry. So again, I think that's driven sentiment in the sector. Because, again, if confirmed, it highlights that China's making further progress to become self-sufficient on chips and chip technology and reduce its reliance on external, mainly Western suppliers.
Yeah, it could be the first domestically produced advanced chip-making equipment, right?
Yeah.
And really kind of similar to what we see from ASML, right? So how should we look at that, right? How significant is that for you?
But how likely is that?
Yeah.
So you have two things, right? You have lithography and you have hyperscalers. Clearly not fully accessible to the Chinese market, hence they have to look inward.
Yeah.
What's a lower hanging fruit between those two things as we try and figure out which of these positive narratives might likely come to fruition earlier?
I think the world we live in at the moment, everything is ultimately driven by chips, isn't it? It's an electronic world. So developing native technology, becoming self-sufficient in chips of all the various priorities has to be number one because it drives everything. And I think ultimately, China will do it. It's just a question of time. So, they've got fantastic engineers. They've got the full weight of state behind them, a lot of state investment. Whether, this story today is confirmed or not, regardless of that, I think in the long run, China is making strong progress to develop its own native chip-making technology. So I think this is, another waypoint in the ongoing direction of travel, if you like. So that was a very convoluted way of saying it. They're making good progress. I guess the key question is, when will they become self-sufficient in mainstream chips? Yeah. They're on the way to doing that. Is that something they could achieve in the next few years? Possibly. But we'll have to wait and see how things develop. The biggest technical barrier to entry is on these EUV machines. These are the very high-end machines, which are really ASML has a monopoly on that. Yeah. That's incredibly hard to do. May take multiple years, in fact, a decade plus to make a breakthrough on that. But again, with the huge resources that China can deploy, I think ultimately a breakthrough will be made. But it could be 10 plus years away.
Robert, thank you, Robert Lee there, our Bloomberg Intelligence senior analyst as well. Of course, we're talking more global news here, and certainly we're watching out of Israel here. So they've started a long, threatening push into Gaza City after weeks of airstrikes and incursions into its outskirts. An Israeli military spokesman says operations will continue until Hamas is defeated and hostages freed. The offensive comes as a UN-commissioned report concludes Israel is committing genocide against Palestinians in Gaza. The report calls on the international community to push to end the war. House Republicans have unveiled a stopgap spending bill to keep the U.S. government open past an October 1st shutdown deadline. The measure would keep agencies operating through November 21st and provide new funding for security. It needs at least 7 Senate Democrat votes to overcome procedural hurdles.
Right, we're turning our attention now to Southeast Asia, Indonesia specifically. There's a Fed conversation. The currency's coming up bottom of your screens. I'm looking at the equity markets, a 1% to the upside. Within the Indonesian story is, well, what does a central bank look like? We talked about the Fed, right? You have lawmakers, well, they're weighing potential changes to the mandate of the central bank, heightening, I guess, some concerns about the central bank's independence, question mark. You have some lawmakers saying that the amendments could also include setting a lower bar in terms of being able to remove monetary policy officials. Let's bring in our Deputy Bureau Chief in Jakarta, Claire Zhao. She's with us right now to help us understand. Claire, I guess markets should care about this. What should investors make, though, of these proposals specifically, Claire?
Yeah, a lot of alarming headlines last night with lawmakers saying they could consider expanding Bank Indonesia's mandate to include job creation, but also to allow the parliament to effectively dismiss Bank Indonesia officials based on an evaluation of their performance. And the reason why this is raising some concerns is because it follows just a few weeks after Bank Indonesia revamped what it's called a burden sharing program, where essentially it will shoulder some part of the debt costs of the president's priority economic programs. So I guess if you're a long-term investor in Indonesia, what you're asking is, after the protests, you're seeing the president tighten his reins on power, pursuing a more aggressive push on growing the economy. What role will the central bank have to play there, and will it have to do some heavy lifting? Obviously, we've seen this trend in the US and even in Thailand here in Asia, but this has been a slow and steady creep in Indonesia. A few years ago, they've already added economic growth to its mandate, and this is the latest attempt now to expand it even further. And if you want to take another step back, you're also seeing that the cabinet reshuffle has removed a long-serving finance minister, potentially reviewing a budget deficit cap. So for an investor, you're asking, you have the Bank Indonesia's independence potentially compromised, a new approach to fiscal policy. What does this mean for Indonesia's fundamentals and its institutions?
Yeah, so that's certainly rattling some investors there, but there's still going to be a Bank of Indonesia decision later on today. What's expected, given a lot of uncertainty when it comes to the political situation there too?
Exactly that, Yvonne. It's that they're expecting Bank Indonesia to hold its key rate for today, essentially to give a sense of calm and take stock of everything that's happened over the tumultuous few weeks that we've seen. You've had violent protests in Indonesia. You've had a cabinet reshuffle, removing a well-renowned finance minister. And the Indonesian rupiah has been the worst performer, among the worst performers in Asia during that time. Another thing that will complicate Bank Indonesia's decision-making is this new program by the new finance minister, which is to flood the economy with about $12 billion. And they've been explicitly ordered not to absorb any of this liquidity. Now, the goal has been to jumpstart lending and to boost economic growth, but this also has ramifications for inflation down the line. Economists are already expecting this could push inflation up higher, up Bank Indonesia's target in 2026. And that means a hold for today, but even longer term, does that mean an earlier end to Bank Indonesia's easing cycle?
All right, Claire. Thank you, Claire Zhao there, our Indonesia Deputy Bureau Chief, joining us out of Jakarta here this morning. We got a lot to unpack of Bank Indonesia later on today. Plenty more ahead. This is Bloomberg.
All right, if we haven't woken our viewers up already, here's something that's going to get you out of your beds. There's a bond auction coming through out of Japan today, 20-year bond auction. So do you think they're going to have difficulty getting this one through?
They might. We've seen a demand being tested, but given this is the first one since the Prime Minister resigned, maybe that does lead to a bit more concerns on the fiscal side of things as well. And yeah, there's also a bond sale in China too.
Yes, and I think the complication here is this recent melt-up in yields and whether or not, of course, we will backstop it. But it's also, all that being said, the recent auctions in Japan have so far gone through without further complications compared to the ones before that, I think back in May and early June. But then again, there's a new complication.
And there's
to the
a
politics.
BOJ this week too.
There is a BOJ meeting this week. I guess we can over-obsess that over tomorrow once we talk about the Fed, look ahead to the Bank of England, and then we could talk about the BOJ on Friday.